In many parts of the country, the housing market is frozen as tariffs, a shaky economy, and conflict in the Middle East keep some potential buyers on the sidelines.
Canada's housing market is absolutely collapsing, and some people, they just want their homes to float away because the loss is so bad.
Report shows many people are drowning in debt.
The number of households that will be required to be evicted is a tidal wave.
You have mortgage interest rates that are still high. You have affordability at terrible levels.
Canada's housing market is sliding hard, and families are feeling the hit as their savings shrink fast. In several regions, home prices have dropped sharply, wiping out years of financial progress in what feels like a blink. Now, many households are buried under debt, stressed about keeping up with payments, and stuck in a market that's no longer working in their favor. The situation has spiraled into a serious financial strain, leaving millions, dealing with losses that are hitting both their wallets and their future plans. This isn't some quiet slowdown. It's a loud, ongoing financial shock that's reshaping everyday life for people across the country.
Yeah, look, everyone is out there still arguing about affordability, but the real problem now is that the entire system is starting to stall.
Yeah, we're not just in a housing crisis anymore. We are now in a construction freeze, and CMHC is basically warning that if this continues, we're going to be short millions of homes again, even after everything that's already happened.
What experts warned about for years is now unfolding in real time, and the numbers are painting a tough picture that's impossible to ignore. Across Canada, home prices have dropped around 20% since their peak in 2022. That might sound like just another stat, but it hits differently when you see what it means for real people. A townhouse in Toronto losing $525,000 in just 1 year isn't just a number. It's someone's savings, someone's long-term security disappearing fast. And here's the tough part. Many homeowners can't even sell to limit the damage.
Canadian home prices and sales have continued to fall for much of the last year in Canada, and the Canadian Real Estate Association has actually downgraded their forecast for the year. This might be one of the most important housing market updates in Canada right now.
Selling now could mean locking in huge losses, so people feel stuck, watching their property values fall without a clear exit. And in Vancouver, the situation looks just as intense. Condos that once sold for over $400,000 are now going for about 22.5% less in some areas. And in parts of Toronto and Vancouver, prices have dropped as much as 24%.
It's a matter of these massive global disasters, really, that continue to unfold.
Now the Canadian Real Estate Association downgrading its forecast, predicting sluggish sales for the rest of the year.
These aren't small dips. These are major financial setbacks affecting regular working families who followed the rules, saved money, and made what seemed like smart investments. Ontario and British Columbia are taking the biggest hit right now. These regions once powered Canada's real estate growth, but now they're dealing with a slowdown that's hard to reverse. Calgary, which many thought was safe, is now stuck too. Buyers can't afford current prices, sellers don't want to drop them, and everything feels frozen like a system that just won't move.
According to the Canada Mortgage and Housing Corporation, there are about 2,500 completed, unabsorbed units sitting empty in Metro Vancouver, double the amount from a year ago.
Quebec and Atlantic Canada are holding up a bit better for now. Their markets didn't rise as aggressively before, so the drop isn't as sharp, but the pressure is building and the effects are slowly spreading. No region is completely shielded from what's happening next. Now here's the part that really hits interest rates. They've become the quiet force changing everything. As of April 2026, the average 30-year fixed mortgage rate is sitting around 6.3%, and that one number has completely reshaped affordability. People who bought homes in 2021 are now facing monthly payments that are about 44% higher than expected.
Those buildings.
Ari Zadegan is a broker that specializes in distressed sales. She says those who bought a condo in the last 5 years and hope to flip it are losing thousands.
The ones that they were only dependent on the flip are the ones that are hurting.
The soft condo market in Toronto could have a long-term impact on housing supply. Fewer people want to invest in pre-construction, a key part of financing, and developers are backing out of projects.
At the same time, Everyday costs like food and fuel have gone up, but incomes haven't kept pace, and that gap is putting serious pressure on households every single month. There's also a hidden lock in the system that's keeping the market stuck. About 68% of homeowners have mortgage rates below 5%, and they don't want to give that up. Selling means jumping into a much higher rate environment, which could cost thousands more per month. So many are choosing to stay put, and that's slowing everything down even more.
Real estate consulting firm Urbanation has tracked 9 canceled projects in Toronto so far this year. For Bazios, he would like to see not only changes to the ways condos are financed, but also to how they're built.
And stop designing these shoeboxes, because nobody wants.
So people stay put, they hold on and don't list their homes. That single choice, repeated across millions of households, is quietly draining the market of available homes. What's left is a strange standoff, sellers hoping for higher prices and buyers simply unable to afford what's out there. Neither side is really winning here. On the surface, things might look stable, but underneath, pressure is building fast. In the Greater Toronto Area alone, more than 20,000 condo units are sitting unsold, just waiting. Buyers either can't qualify for loans or are stepping back, unsure about jumping into a shaky market. Developers are feeling the squeeze too. Money is tied up, projects are slowing down, and new construction is getting delayed.
As of April 2026, the average 30-year fixed mortgage interest rate is around 6.3%. Now, I want you to compare that to around 3% in 2021 and over 7% in 2023. So yes, rates have come down from their peak, but they're still high enough where it's hurting affordability.
At the same time, prices haven't dropped enough to attract strong demand because many sellers are still holding on to past expectations instead of adjusting to current realities. Toronto's condo market has now hit its lowest sales level in 35 years. That's a huge shift. Sales activity hasn't been this quiet since before many younger buyers were even part of the market, showing just how much things have cooled off. Vancouver is seeing a similar pattern. Unsold condo inventory has climbed past 2,500 units, and it keeps rising.
March sales were unchanged month over month and actually down year over year. And they've sort of stopped talking about this idea of pent-up demand. You know, we're not in a recovery, obviously. We're not really in a crash anymore. Prices are trending down, grinding down slowly. We're in a pause with a lot of tension building underneath. And buyers basically seem like they're being sidelined by falling prices, according to TD's most recent forecast. And then obviously just economic uncertainty, job uncertainty, etc. So
when developers can't sell existing units, they struggle to fund future builds, which slows down new housing supply, even while demand for housing remains high. Then there's another major pressure point, mortgage renewals. This is a big one. Many homeowners locked in low rates during 2020 and 2021, and now those terms are ending. As they renew at today's higher rates, monthly payments can jump by $2,000, $3,000, or even more depending on the loan. That kind of increase isn't small, it changes everything. For many households, it means cutting back, reshuffling budgets, or struggling to keep up with rising costs. In Ontario, early signs of strain are already showing.
This Toronto condo just sold at a massive loss of over $300,000. This 2-bedroom condo at 1888 Queen Street East in the Beaches sold back in April of 2022 for nearly $1.5 million. Well, the condo was just sold again in May of this year for nearly $1.2 million, representing a staggering $305,000 loss.
Mortgages that are 90 days overdue have doubled since 2025. That signals growing pressure as some households fall behind on payments and find it harder to recover. If that trend continues, it could lead to more homes being sold under pressure, often at lower prices. That would add more supply to the market, push prices down further, and increase financial stress for other homeowners. It's a cycle that can build momentum if conditions don't stabilize. On the policy side, efforts have been made to support the housing sector, but results have been mixed. Large amounts of funding have been introduced, with some aimed at increasing housing availability and supporting development. For example, a program in the Greater Toronto Area is allocating $1.3 billion to convert unsold condos into rental units.
Roughly 1 million Canadians are renewing their mortgages this year, including Elias Eid. His monthly payments went from $2,000 to $3,600.
I had to double my withdrawal from my RSP to be able just to cover the mortgage and the property taxes. That's how painful it was. But, that's life.
While that sounds like a big step, it currently targets only a small portion of the total unsold inventory, meaning the broader imbalance remains. There are also investment funds focused on long-term housing development, but questions continue about how effectively these efforts are reaching everyday households versus larger industry players. When the people running major housing rescue programs come straight from banking and development circles, it raises a serious question. Are public funds actually fixing the problem or just supporting the same system that helped create it? Without clear transparency and real accountability, these partnerships risk turning into costly efforts that don't fully reach the families who need help the most. These programs are often presented as bold solutions, but without measurable results, it's hard to know what's truly being achieved. Meanwhile, many households are still dealing with financial pressure, trying to stay afloat in a market that feels increasingly unstable.
Toronto mortgage delinquencies have tripled since 2022. In the GTA, power of sale listings have doubled in just 1 year. In some Ontario suburbs, they now make up 10% of active listings. That used to be close to zero. This isn't a forecast, it's already happening. Here's the trap no one saw coming. Between 2020 and 2021, Canadians flooded into the market. They locked in 5-year mortgages at 2%. Now those loans are hitting renewal. The new rates are 4 to 5%. That shift doesn't increase payments, it detonates budget.
Beyond the current situation, there's a deeper issue building up. Canada is expected to need millions of new homes by 2030, according to housing projections, but construction levels are still far below what's required. Developers are facing a tough environment. They can't move existing inventory easily, building costs are high, financing is expensive, and approval processes in major cities like Toronto and Vancouver take a long time. All of this slows down new supply, even as demand continues to grow. This creates a difficult imbalance. Housing remains expensive, yet at the same time, there still aren't enough homes being built. That combination puts pressure on both buyers and the broader economy. For younger buyers, the barriers are getting even higher. Even if prices drop another 10 to 15%, many still can't enter the market. Higher interest rates, stricter mortgage rules, and income growth that hasn't kept pace all make it harder to qualify for a home.
This is very much a wait-and-see market, right? They're waiting to see if prices are ever going to go back up, if interest rates are going to come back down, if they're going to have a job in a couple of months, if the trade war is still going to be going on, if oil prices are going to cause massive inflation and keep squeezing the pocketbooks of Canadians and they won't be able to afford a house. There's a lot of things that are preventing people from wanting to pull the trigger on what is the biggest financial investment of most people's lives in Canada.
As a result, home ownership is starting to feel out of reach for a large portion of the population. More people are relying on family support or existing wealth to enter the market, which changes the long-term landscape of housing access. Another shift is happening with global investment. International buyers who once saw cities like Toronto and Vancouver as strong real estate opportunities are starting to look elsewhere. Markets in regions like Southeast Asia or parts of Europe are becoming more attractive due to different returns and conditions. That shift matters because foreign investment has historically been one of the factors supporting property values. With less of that capital flowing in, the market may face additional downward pressure.
Ontario just announced a bailout program, selling it as a housing affordability measure. The province launched a $1.3 billion public-private partnership to buy stagnating developer inventory across the Greater Toronto area to convert into rentals. We all know the condo market is dead. We all know
The condominium market is absolutely dead right now.
that sales have stopped.
We're seeing sales have stopped.
What's happening now doesn't look like a short-term dip that quickly recovers. Several key factors are all hitting at once: higher borrowing costs, slower construction, and ongoing financial pressure from mortgage renewals. Many homeowners are adjusting to significantly higher payments, and that strain is spreading across the system. Each renewal cycle adds more pressure, especially for those who stretch their budgets during lower rate periods. Right now, the market is holding steady in some areas, but the underlying challenges haven't fully cleared. For years, real estate was seen as one of the most stable investments, encouraging many people to take on large mortgages. Now, with prices adjusting and costs rising, that assumption is being tested in a major way. So the big question moving forward is clear. Can the housing system rebalance and stabilize, or will affordability challenges continue to reshape what homeownership looks like in Canada? And that's the situation for today on Yesterday Canada. If you want more updates like this, drop your thoughts in the comments and subscribe so you don't miss what happens next.